go forward?
Okay, not too many have clarity on that. Arvind Sanger is joining us, managing partner of Geosphere Capital Management. Arvind, hi, good morning. Thanks a lot for joining us. Now, this is, this is one issue where we do not have too much clarity, right, on how things are going to progress. And the market's been swinging according to the headlines over the last few days, but more down than up. Your thoughts, also considering that this comes at a time when the market anyway was struggling with the Fed, the inflation, and the bond yields. Your first thoughts.
Well, clearly this is going to be inflationary, right? Whether or not the U.S. and Europe sanctions Russia more fully, which I think at this stage they are not going to, because I think they're still trying to prevent Russia and President Putin from going into the rest of Ukraine. So they're trying to keep something. So they're, putting sanctions on the breakaway republics is really, a bit of a joke, to be perfectly honest. There's not really anything coming out of there that's going to hurt anybody. But it does raise global risk factors. Oil markets were already tight on a supply-demand basis. There's news that the Iran talks are not going so well. Oil is headed towards 100. It's going to get there with or without sanctions on Russian oil. Certainly, if there were sanctions on Russian oil, it would get to 150. Natural gas prices in Europe already the equivalent of 150. If there were any sanctions on Russian gas, they would go to 300 equivalent, right? So those are clearly, I think, not on the table, because I don't think Europe can afford it. I don't think the world can afford it in terms of sanctions on those. But anytime tensions rise, there are a lot of commodities that come out of Russia. Those prices will remain elevated even without any hard sanctions, just risk adjustment for, we don't know what President Putin is going to do next. We don't know where Russia will go. We don't know what the West will do. That is going to raise prices. That is inflationary. You are seeing risk off in markets. That's going to affect, the Indian rupee has had this sharp rebound over the last few days. I guess, you were discussing earlier whether that's related to the expected inflows into the LIC offering. But I think from an inflation, current account deficit, any other measure, this is going to be negative for India and therefore potentially for the Indian rupee.
Arvind, hi, good morning. Give and take all the headwinds that we've seen so far, the market has not even corrected 10%, right? I mean, the high that we saw in October was around 18,600. Now we're around 17,200 on the Nifty. Do you think that even with this issue, even if the geopolitical issues escalate further, the market could sort of take it in its stride, the Indian markets, that is?
Could. I mean, I guess I have to admit that I'm impressed with the fortitude of Indian retail investors and therefore Indian institutional buyers. They have stepped up and continued to buy. But I think it depends on what happens in the global markets. At the end of the day, India is not an island. We have never, ever seen the Indian markets delink for an extended period from global action, right? So it depends on how things, if things remain, none of the global markets have corrected huge amounts. But if things remain under control and, there's mild sanctions, President Putin, saber rattles, threatens Ukraine, but doesn't go further beyond these eastern regions that Russia has recognized and moved into, then maybe markets have a 1 or 2 day kind of a short scare and then go sideways to up over time. That's certainly the most optimistic case. The pessimistic case is, rising commodity prices. And the not super pessimistic, the mildly pessimistic case is rising commodity prices, tightening, interest rates and liquidity in the West. Both of those combine to cause some economic pain around the world, and certainly in emerging markets also. And that could cause a sharper correction. It's not by any stretch. I'm not saying we're at the end of an economic cycle. We're just at the beginning of it. But corrections, when they happen, don't usually end down 10%. So, in my opinion, it would be fairly unusual if global markets avoid this whole risk off without a more meaningful correction than everything we've seen so far.
Arvind, so in the meantime, while you're basically saying that there perhaps is more to go, it'll be unusual for the market to just bottom here. That's not how corrections play out. What should investors really do? Wait this one out? I mean, if they've managed to create some cash, some dry powder, start to put that to use a little bit. What's your sense?
I think patience is a virtue at these times. And I think having clear target prices for companies that people believe in long term is good. Having companies with strong earnings, which are not impacted by high energy prices or squeezed by high inflation, that's an important point. And then in that sense, I think putting money to work patiently over the next few days and weeks, but being clear-eyed about what sectors you're buying. I mean, one of the biggest, I think we've had this conversation before, one of the biggest mistakes people can make is, get lost in the reference bias, so that, a no-profit company is down 30-40% from its recent highs, and therefore it's cheap. That is not the value. That is not, even in these markets, the measure of cheapness is not how much stocks are down from their highs. The measure of cheapness is where they are on their valuation relative to a realistic expectation of where earnings can go. And and using historical valuations of simple things like price to earnings, EV to EBITDA, and predictable cash flows. And those are important metrics. I don't think you go wrong using scares like this to patiently buy, but I think patiently buying in the right sectors is as important as whether to buy or not.
That's an important point, and there's been a a bit of a valuation reset which has been on. And Arvind, I mean, even before this whole Russia Ukraine issue sort of started, we saw, for example, a big correction back home in Indian IT stocks or all these platform companies, which were the darlings of the stock markets last year, all through last year. You think there's more reset left here in some of these stocks?
Well, I've been saying for several months now, I think these are the biggest losers of a rising interest rate cycle and the disappearance of free money, because these are companies that whose discount rates rely on very low discount rates to discount earnings, several years out into the future when the earnings actually show up. So therefore, I'm hesitant to buy any of these stocks till I have a clear idea of when the earnings are coming near term. For distant earnings, I'm willing to pay a lot less than I am for companies which are earning a lot of money now and that are going to be somewhat immune to the near-term risks. So yes, I'm not bottom fishing at all in any of these fallen, high-flying tech unicorns or other such high multiple stocks.
Just one final question then, Arvind. Is this a time to be relooking at your asset allocation? I mean, should one move money out of equities and into perhaps other asset classes like gold or maybe in real estate because of the tensions that are brewing currently and the overall headwinds that are present in the equity markets?
I guess I have been trying to inflation-proof my portfolio for several months now. So I do believe that commodity sectors, real estate, and things connected to those are much better places to be than in some of the go-go growth areas. But that doesn't mean that domestic healthcare spending is going to not do well. That is going to do well post-COVID. So some of these things will remain. But yes, in a portfolio where people got used to low inflation, is there room for some inflation hedges, whether that's like you said, gold or real estate? But real estate equities are hugely underowned, and so it doesn't have to be that you have to go buy hard real estate. You can buy real estate equities. So my view is that whether it's a stock market or it's other real assets, the one thing that I would say is that fixed income in India is not risk-free right now, because I think, and I've been saying this for several months now, I think RBI has been too benign and too slow to take into account in where inflation is going, and therefore the one area that I would not be looking at is Indian fixed income, but in terms of equities which are inflation-proof or other asset classes which are inflation protected, I would say that would be a good idea.
Okay, all right, I got that. Arvind, thanks a lot for joining us and have a great day. So perhaps inflation continues to be a bigger threat than the geopolitical issues, something that the market has been grappling with for a while. Let's slip into a short break. On the other side, we'll try and draw up a list of stocks and companies that could get impacted because of all that's brewing globally, and of course the other stocks in the news as well. Stay with us.